Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now here on Market Talk is we broadcast live from the Big Iron Farm Show up here in Fargo, North Dakota. He joins us from his home office. Bill Biedermann of agmarket.net is with us here today. Bill, good to catch up with you again, sir. How are you today?
I'm doing real great. I wish I was up there. I bet that's a great show this year.
It is. It is a lot of fun. It is a beautiful weather and really looking like great crowds on day number one. And we are looking forward to very fun couple of days up here at Big Iron. And I know a lot of folks, I've already heard the conversations. They're talking the markets. I think top of mind, CPI inflation numbers coming out on Tuesday, a little bit higher than expected. I think that just goes to show us that inflation is still hanging around. And that really overall felt like a wet blanket, although it felt like the grains held up fairly well despite the broader sell-off in the stock market, et cetera, today, Bill.
That's right, because the Fed's policy is intended to change behavior of consumers for durable goods like TVs and shoes and things like that, but they can't really control food because food is based on yields and supply and demand. However, it does have an impact on the fund trading. And the funds, if they're perceiving a deflationary, risk-off kind of an environment, they're going to sell. And coming into today, they were very large longs. They were long 239,000 contracts of corn and 124,000 contracts of soybeans. So seeing this selling is not a big surprise given the Fed's policy and given the numbers that we saw today. We still have to reconcile, though, how we're going to resolve this tight food situation.
Very, very true. Well, in the WASD out on Monday, that soybean number, all the numbers, honestly, but especially the soybean numbers really stunned me. And just looking at the balance sheets, I mean, the soybean balance sheet especially now looks really tight, Bill. What are your thoughts after we got those numbers from USDA? What really stood out to you, and what are your thoughts now that we're post-report here a little over 24 hours?
Well, on the soybeans, they lowered the demand, about 45,000 or about 90,000 million bushels. I'm sorry. The big thing for me was that they ended up with a carryover of 4.5%. Well, our old crop carryover was 5.3, almost 1% higher. And yet prices went all the way up to $17.84 to put in the high. We're down here at $14, $15. If we really do have to cut demand more, we're not high enough. South American crop has got to come in at 150. This puts tremendous pressure on Brazil to perform. USDA has them at 149. It can't get any smaller than that. And if it does, you gotta cut demand somewhere. And it's the same thing in the corn. They cut the corn demand by 250 million bushel. That just got us down to a 1.2 carryover. That's what you need in order to run trucks, trains, and bin sweeps. So we're down to pipeline requirements, Jesse, and that left us with a carryover of only 31 days. We had 37 days of carryover in hand last year on the old crop, and prices went to $8.27 during delivery. So that tells me that we just don't have any room. It tells me that if we went to 820 last summer, we could go that high this year, but you have to have a catalyst. And again, the thing that you mentioned that we're up against is a negative Fed policy, a deflationary Fed policy, and a huge South American crop coming on. If that doesn't perform, every bushel that we have to cut back on further, like let's say they lower yield on the next report, every bushel we take off, we'll have to pull that right off of demand in order to keep that pipeline carryover. And I'll also say this, when you lower the crop on this last report, there's a 70% odds you'll lower it on the next.
Well, and thinking about that, if we see it lower, and I think there's a lot of thought out there, crop's getting smaller. It's going to keep getting smaller. Seed size issues, I think, are being seen in the Western Belt. I just look at this and then I think about a risk management perspective, Bill. If I'm a producer right now, feels like that I would be smart if I got some floors locked in because it feels like, yes, even though this could go higher, it would be smart to maybe make some moves right now. But I wonder your thoughts, just risk management here moving forward after seeing this September WASDE numbers.
Absolutely. So what we're looking at doing, we're in that 50 to 60% sold mark going into this. If you've got good yields out there, it's be okay to sell some more. You can always replace it with a call. We can put call spreads on for like 15 to 20 cents. That's not very much money when you're talking about the kind of numbers we're talking about now. But if you're going to just put everything in the bin, and if you're in an area where they're not bidding strong premiums on basis, you should put it in the bin. And if you do that, then we would highly suggest a floor, buy a put if you're willing to put a ceiling price on it. I know the guys in the office were talking today about something like a $14.80 or $15 floor with like a $16 or $17 ceiling price. Very reasonable to do. If you're not willing to take $17 on your beans, then I feel sorry for you.
Well, that's just it. It just feels like that there's a lot of opportunity here to lock in some profit, especially as we near harvest. And I know some folks have some questions about their crop, and it's a situation by situation basis. But I think overall, just looking at things, I mean, to me, that makes the most sense. I don't have skin in the game. I just talk to folks like you who know way more about this than I do. But to me, it makes sense to try and find at least a little bit of profit here, because like you said, if $17 beans is your worst sale, I mean, I think you're gonna be pretty happy about that, wouldn't you?
Oh, absolutely. So, we're all speculators, every one of us. If you're an investor, if you're a farmer, you investing is speculating, right? You're betting on something working out for you, and you're putting money down on the table to do that. But what's really unique about this situation is that you can spend a little bit of money and guarantee yourself phenomenal returns, assuming you have a crop. Now, if you're living in Kansas, I'm really feel bad for you. Penny and I just went through there, and it is a disaster. There's no doubt.
Well, as well, another issue that I think is looming over the entire ag sector and really our entire economy is this rail strike potential issue that could be coming up here. I know we're waiting to see this week if anything happens, and I know you've heard a few things here today as well. But if this strike, if a lockout happens this weekend, Bill, right as we're nearing harvest time, I can't imagine what this would do to the ag economy and the economy as a whole.
Yeah, that's right. So, I went back and looked at times when we've destroyed demand through situations that weren't due to price. And if we do knock the knees out from underneath this thing, it could be 2 to 3 years before we really recover as a reliable supplier. Right now, down at the Gulf, corn is bid at $1.15 over, $1.45 over for FOB. I would think that the Gulf market could go to $2 over pretty easy. I know they're paying 2 over in Kansas. But I listen to Bloomberg in the background because I want to hear what the speculators in New York are thinking. And they're all worried about it, creating this food shortage. So we might get a knee jerk up, but I think the backside of that would be really negative because of the buildup of supplies.
Well, and as well, if we can't move grain by rail, I've heard some talk of some folks trying to get, say, corn from Illinois to Kansas. You mentioned disaster down there, feedlot country. They're trying to book some corn and bring it from east to west, which in a normal year is kind of hard to do. But then if you throw it a rail stoppage, I mean, that could spell some really troublesome stuff for cattle producers in the southwestern feedlot regions, Bill.
Oh, it would be horrible. I can't even think about it. I mean, just from the poultry to the cattle, it would be a feed end user's nightmare. What would you do with those livestock? You could force liquidation if it were to last. Now, let's think optimistically. 1 out of the 4 unions did agree to terms today. I think the union still has to vote for it. The other 3. I think they want to solve it. They're at the table talking. If they don't get further by the end of tomorrow. I believe that's when government officials will step in and try to mediate. I hope it gets worked out. That's all I can say.
I agree. I agree with you as well on that one. Looking a little more, just thinking about the CPI data and its effect on, say, the energy market on Tuesday. Crude oil has come down quite a bit, and it's kind of been holding that low 90s range. What is your thoughts on the energy market here moving forward, Bill?
Okay, so as long as the Fed looks like they're going to be able to pursue a deflationary type of an environment, financial policy will affect almost everything except food because, we know that there's the supply of oil. You just have to pump it, right? And we also know that this policy would cause consumers to stop traveling so much. And so that would put pressure on it. So that would probably be a negative on almost every commodity except for something in tight supply. I hate to keep laboring on corn and beans, but Jesse, I can't stress enough how significantly important the South American production is, because there's only two ways to solve a shortage. Number one, you got to cut demand and kill demand. And if you do that with price or with an outside influence like the rail strike or an embargo, it's very destructive to price for 2 to 3 years. But if you aren't killing demand and we don't see a big supply bump in production down in the southern hemisphere, Jesse, a 31-day supply isn't going to. I mean, let me just paint a picture. When a hurricane is coming, the very first reaction by social behavior is, "Oh, cool. Okay, well, we can ride that out," and there's no panic. But when the storm is on the doorstep and they go, "Holy buckets, that's a big one. This could be really bad. It could wipe us out." Behavior changes dramatically when fear gets involved. They run to the stores, they buy everything they can, and they start batting down the hatches. And that's exactly where we're at in the grain markets. If we don't see either demand destruction this year for either price or outside influence, or we don't see a big crop in South America, that to me is the key. We got to get 150 million tons. And if we aren't getting it, we could see this change from, oh, well, we'll get through it, no big deal, to fear. And if we do that, the world is already experiencing shortages in regions. But this could get big. The EU crop is probably 10 million tons smaller than what they're saying. That's huge. This has only happened 2 times in history when we've seen a situation like that. And if we see a South American crop failure or crop reduction, we've only seen one situation in all of history, well, recent history, since 1950. We saw it happen in 1961, where it was this close or this significant to a problem. So, what I'm saying is this is a phenomenal price to get income locked in, but make sure you're doing it so that you have maybe 25 to 50% of your ownership open on the upside, even if it's an out of the money call. Because if this does fall apart on the production side, there will be a lot of carnage.
Well, Bill, I think we'll leave it at that. Great advice. And if folks want to talk to you, want to talk to the team at agmarket.net and get a little more advice, talk about their individual situation, I know they can do that very easily. What's the best way to get a hold of you guys?
Well, you can call us at 844-4AG-MRKT. That's Ag Market. Or you can go to agmarket.net, go right on their website. We're all right there. You can even sign up for some free research for 30 days.
And I know as well you guys have a great app that you can download in your App Store, Google Play Store as well. And we appreciate the time. Thanks for joining us here today. And as always, look forward to talking to you again real soon. Bill Biedermann of agmarket.net. Thank you, sir. Have a great day.
You too.
And that's going to do it for Market Talk here today as we broadcast live for the Big Iron Farm Show in Fargo, North Dakota. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.